Welcome to Live Wire Markets. My name is Vishal Tekshandani. Thank you for tuning into The Pitch. Joining me today is Joe Millward, founding partner of Epsilon Direct Lending, and he's going to share his past experience of living through the global financial crisis and why it's important for you as an investor to look to private lenders who have that experience of going through past market crises. Joe, welcome. How are you?
Thanks for having me. Good, thank you.
So Joe, everybody in private lending land is talking about the opportunity, but what happens when things go wrong? What kind of protections does a private lender have in place for investors?
So capital is at risk, Vishal. Investors aren't earning 8, 9, 10, 11, 12% per annum risk-free. So what can go wrong is investors can lose capital. When you're lending, that means that you've had a default, a failure to pay interest or principal as it falls due, an insolvency event, a receiver or an administrator might be appointed to a company, and the recovery rate when you go through a workout might be less than the face value of the loan that you've extended, which can result in a capital loss to investors. And we're in benign economic conditions right now in Australia. Things are reasonably smooth sailing on a long-term historical basis, and we haven't had a recession here, a true recession, since the 90s. And so it's very easy to run into a false sense of security with a lot of narrative at the moment out there about the growth of private credit. We think at Epsilon it's critical to understand the importance of having real workout experience, having lived through a significant downturn.
Okay, nothing gets me more excited than hearing about past experience. Now, you've lived through the GFC. You've also done this in the UK, arguably tougher economic conditions than Australia. How bad can things get?
Yeah, so Epsilon was founded by 3 people, Vishal. There's me, I'm from the UK and worked in private credit funds management from 2001 until 2010. Mick Wright-Smith worked in Barclays in Europe through the GFC, so in a banking role, and Paul Nagy was in restructuring advisory. So we bring a really complementary skill set of having had direct experience of just how bad things can get. So how bad can they get? Well, in Europe, they got pretty bad. In the US, they got pretty bad, a substantial downturn. A lot of private credit lenders that were established at the time experienced significant losses. And so what I'd encourage investors to think about is the value of having access to an investment committee and owners of a private credit fund that have been through that experience where you wake up one morning thinking you've got 2, 3, 4 loans on your watch list that might be underperforming with covenant breaches, and then being told by a private equity house that another one's gone bad. You get the results the next day and another one's gone bad. This was a rapid succession of companies that were materially underperforming in a short period of time.
Okay, so Joe, a position starts underperforming, investors get worried about their capital. What protections do you have in place? You've got lots of access and lots of collateral in terms of what you've secured with the people you're lending to. Help us understand the protections investors have.
The loans are senior secured. So what that means is if a company does default and you have to recover against the security position that you have, you're the first creditor to get your money back with a senior security position. So what you're trying to do is ensure that the value of that security, collateral, in our instance, the going concern value of the company, exceeds the value of the loan, and that you've got safety mechanisms in place so that you can take action well ahead of that impairment risk occurring, that value of the company going below the value of your loan. And typically what you have in place, and all of our loans have this, are financial covenants. So they allow you to take enforcement action upon a breach occurring of a covenant.
Yacht, huh?
Take the yacht, yeah, in an example that I can certainly come to. And so that allows you to start negotiating with the shareholders of the company whose capital is first at risk, and see what they're going to do about it as the owners, see what the C-suite are going to do about it, the CEO and CFO in terms of getting the company back on track. You can strongly engage, you can suggest improvements, but at all times you're ensuring that the value of your collateral, your security, the enterprise value is highly likely to exceed the value of your loan.
So Joe, you've argued that a key differentiator for Epsilon is not about how much money you make when things are booming and the cycle is favorable, but more about risk mitigation. Can you walk us through how you mitigate risks more?
Yeah, we believe long-term sustainable and defensive returns to investors are defined financially by the experiences you have in a downturn. It's not easy, but it's not hard to make consistent returns when the times are good, because you're charging an interest rate to borrowers, and when times are good, they're profitable companies that can pay that interest rate. You pay that on to investors, you're at target return. But what happens when companies underperform? What happens when there's a recession, as there was in '08 in Europe, which we worked through as a team? Well, funds can suffer capital losses. And so your long-term track record can have a significant downturn through recessionary environments. And so we believe that the managers that focus on return of capital, not return on capital, are going to stand out through long-term market cycles. And so we'd encourage investors to really inspect how much experience the owners of the private credit fund they're seeking to invest in, the investment committee members of that private credit fund have in working through real downturns, real recessions in global markets that are tried and tested, so that their investment philosophy, their investment recovery methodology has actually been put to the test.
Okay. And Joe, can you walk us through the red flags you look for, no matter how good economic conditions are? There's something there about that borrower, you're going to avoid them. What are those key criteria that you look for?
Yeah, there are a lot, and it differs by people's experience, and there are three of us that have worked in downturns, so we've got different perspectives on the indicators, the red flags that would cause you to really question things and possibly not lend. For me, I look for a business that can clearly articulate in simple terms how they make $1 of free cash flow, because if the owners and the leadership team of a business can't articulate that, then something's up, or they're not as capable as we hope them to be. Also, transparency for us is huge. We want full access to a business's entire financials, their staff, their premises. We inspect their sites. We meet the various layers of the management team to really kind of stress test how embedded the culture is in a firm, how well understood the business's reason for existence is across a firm. And so we really kind of go deep and seek the transparency to allow us to do that. And in turn, we offer our investors a similar level of transparency where we're really proud of the companies that we lend to because they're performing, growing companies. And so we offer quite a lot of insight into our own investment portfolio when speaking to investors.
So Joe, you've talked about how bad things can get. Can you give us some examples of companies and how tough they've done it during downturns?
There were some really unfortunate situations. Working with a company and the leadership team and the shareholders that are doing it tough isn't a fun thing, but is what our investors pay us to do. We provided loans to a range of companies that significantly underperformed through the GFC. There was a large Italian luxury yacht manufacturer that had a lot of orders pulled and actually had some fraud that was alleged through their financials that led us to have to take recovery action. Taking possessions of stock yachts and so on was part of the role there. There was a situation with a large manufacturing business, which was really quite unfortunate, where we were having discussions about recovery due to significant underperformance again of that manufacturer. And there was a highly emotive session that we held with the C-suite where the founder and owner of that business actually got really quite upset in front of a lot of people. So you're dealing with people's livelihoods through these experiences, and I think you need to deal with these situations with a lot of humility, but ultimately you're there to protect investors' capital. You take security for a reason, and at Epsilon we think that having the direct experience of working through such a range of underperforming scenarios really positions us well to outperform during another downturn, because one will happen. It's not if, it's when.
So Joe, you had these difficult meetings in these difficult situations. What was the end outcome in terms of how you protected investors?
As we worked through the GFC, we had some losses in our portfolio. There were some impairments, but thankfully we had some companies that we actually got back on track. We turned around and made substantial gains through that downturn. We bought bank loans way below par as banks became forced sellers and made significant capital gains on that investor capital. So part of what Epsilon brings is a rating agency proven publicly available track record that demonstrates that out the other side of the GFC, all of our investors' capital was repaid at par.
Okay, wonderful. Joe, thank you so much for your time.
Pleasure. Thanks for having me.
No worries. I hope you enjoyed that video. Really important to think about the experience that your private lender has before considering investing in a private lending fund. Please don't forget to like this video and subscribe to our channel. My name is Vishal Tekshanani. Happy investing.